Most investors don't lose money because they choose the wrong stocks. They lose money because they ignore the warning signs. Warren Buffett has often said that successful investing is not about making brilliant decisions every day. It is about avoiding stupid mistakes. In fact, Buffett believes that the easiest way to grow wealth is not by chasing big winners, but by staying away from bad investments. Avoiding mistakes matters more than chasing profits. Buffett understands one simple truth. The first rule of investing is not losing money. When you lose money, compounding works against you. A 50% loss requires a 100% gain just to return to the starting point. That is why Buffett focuses more on risk avoidance than excitement. Bad investments rarely look bad at the beginning. They often look exciting, popular, fast-growing, and full of hype. Buffett avoids all of this noise. One of Buffett's strongest filters is simplicity. If a business is too complicated to understand, he walks away, even if it promises extraordinary returns. Risk, according to Buffett, comes from not knowing what you are doing. Many bad investments begin with complex business models, fancy financial engineering, and too many assumptions. Buffett avoids companies that require constant explanations to justify their value. He never invests just because something is trending. He asks simple questions. How does this company make money? Can I explain it clearly, and what could go wrong? If he cannot answer these questions with confidence, he does nothing. Doing nothing is often the smartest decision. Most bad investments happen when investors chase hot sectors, follow social media hype, or copy others without understanding. Buffett stays inside his circle of competence, and that discipline protects his capital. Fast growth is another common trap. Many investors believe that high growth automatically means a good investment, but Buffett disagrees. High growth attracts competition, often requires heavy spending, and can hide weak economics. Buffett prefers predictable businesses over flashy growth stories. A company that grows steadily for decades is usually far safer than one that explodes in growth for a short period and collapses later. Management behavior is another critical warning sign. Bad investments often involve management teams that are overconfident, blame external factors, make excessive promises, or avoid accountability. Buffett avoids companies where management talks more than it delivers or focuses on stock prices instead of business quality. He values honesty over optimism. He is also cautious about the illusion of cheap stocks. A low stock price does not automatically mean value. Many stocks are cheap because the business is weak. Buffett avoids businesses with declining fundamentals, no competitive advantage, or uncertain futures. He prefers paying a fair price for a great business rather than a cheap price for a bad one. Market predictions are another danger zone. Buffett does not predict markets, interest rates, or economic cycles. He believes that trying to forecast the market is a waste of time. Bad investments often begin with macro predictions and speculative bets. Instead, Buffett focuses on what he can control: business quality and long-term economics. Patience plays a crucial role in avoiding bad investments. Many investors make mistakes because they feel they must always be active, fear missing out, or want quick results. Buffett is willing to wait for years if necessary. He often earns the most by doing very little. Avoiding bad investments protects capital, preserves clarity, and improves long-term results. In investing, activity does not equal intelligence. Buffett's success is built on discipline, simplicity, patience, and the ability to walk away. Avoiding obvious mistakes is often more powerful than finding extraordinary opportunities. One of the biggest reasons investors fall into bad investments is that they ignore clear warning signs hiding in plain sight. Warren Buffett pays extreme attention to these red flags, and the moment he sees them, he walks away without regret. One major red flag is excessive debt. Buffett believes debt is dangerous because it removes flexibility. A company loaded with debt may look successful during good times, but when conditions change, debt turns small problems into fatal ones. Buffett avoids businesses that rely on borrowing just to survive or grow. He carefully looks at whether a company can comfortably pay its debts from its own earnings. If a business needs constant refinancing or depends on favorable interest rates, Buffett considers it fragile. Fragile businesses make bad investments. Another critical warning sign is inconsistent earnings. Buffett dislikes companies whose profits rise and fall unpredictably. Volatility in earnings often indicates a weak business model, intense competition, or lack of pricing power. Predictability, not excitement, is what Buffett wants. Buffett is also cautious of businesses that depend heavily on a single product, customer, or market. Overdependence increases risk. If one thing goes wrong, the entire business suffers. Strong companies are diversified within their core operations, not dependent on one fragile source of revenue. Accounting tricks are another area where bad investments hide. Buffett is suspicious of companies that frequently adjust earnings, use complex accounting language, or highlight non-recurring items year after year. If something is recurring, it is not non-recurring. He prefers companies with clean, simple financial statements that reflect reality rather than creativity. Complexity in accounting often signals management trying to hide weak performance. Buffett also avoids businesses with unclear competitive advantages. If competitors can easily copy a product, undercut prices, or steal customers, long-term profits are at risk. Without a durable edge, even good companies can turn into bad investments. Management incentives matter deeply to Buffett. If executives are rewarded for short-term stock price movements instead of long-term business performance, decisions will favor appearance over substance. This often leads to reckless expansion, bad acquisitions, and value destruction. Buffett studies how management allocates capital. Bad investments often involve management teams that chase growth for the sake of growth, overpay for acquisitions, or expand into areas they do not understand. Another silent warning sign is constant change in strategy. Businesses that frequently reinvent themselves are often searching for answers they do not have. Buffett prefers companies with a clear, stable strategy that works over decades, not quarters. He is especially cautious with businesses that promise revolutionary change, guaranteed returns, or, once-in-a-lifetime, opportunities. Extraordinary claims require extraordinary evidence, and most of the time, such promises end badly. Buffett also avoids industries where long-term economics are uncertain. Rapid technological disruption, heavy regulation, or unpredictable demand increases the chance of permanent loss. If future earnings cannot be reasonably estimated, the investment becomes speculation. Finally, Buffett listens to his own discomfort. If something feels forced, rushed, or overly complicated, he trusts that instinct. Experience has taught him that unclear investments usually turn into bad ones. By identifying these red flags early, Buffett eliminates most. Losing investments before money is ever committed. Avoidance, not prediction, is his greatest edge. Another common source of bad investments is emotional decision-making. Warren Buffett believes emotions are the greatest enemy of long-term success, and he works deliberately to remove them from his process. Fear and greed drive most poor investment choices. During market booms, greed convinces investors that prices will rise forever. During downturns, fear pushes them to sell at the worst possible time. Buffett avoids both extremes by staying rational and disciplined. He refuses to follow crowds. When everyone is excited, he becomes cautious. When everyone is fearful, he becomes curious. This counter-cyclical thinking protects him from the emotional traps that ruin average investors. Impatience is another hidden danger. Many bad investments happen because investors feel pressure to act quickly. They believe opportunities are rare and that hesitation means missing out. Buffett rejects this mindset completely. He knows opportunities come again and again, but capital lost is hard to recover. Buffett is comfortable holding cash when nothing makes sense. Cash, to him, is not a wasted asset but a strategic position. Holding cash gives him the freedom to act decisively when real value appears. Overconfidence is another emotional trap. Investors often believe past success guarantees future performance. Buffett reminds himself that markets are unpredictable and that humility is essential. The moment an investor believes they cannot be wrong, mistakes multiply. He also avoids storytelling investments. Many bad investments are supported by beautiful narratives rather than solid economics. A compelling story can hide weak fundamentals for a long time. Buffett ignores stories and focuses on numbers, behavior, and long-term reality. Another emotional mistake is anchoring to past prices. Investors often refuse to sell or reassess because a stock once traded higher. Buffett evaluates businesses based on current value and future prospects, not past market prices. Buffett also avoids frequent trading. Constant buying and selling increases costs, taxes, and emotional stress. He believes that time, not activity, is the investor's greatest ally. He accepts that mistakes are inevitable but works to ensure they are small and rare. This is why he prefers businesses with simple models, stable demand, and strong balance sheets. Simplicity reduces emotional strain. By building a process that removes emotion, Buffett avoids impulsive decisions. He relies on preparation, patience, and discipline rather than instincts in the heat of the moment. Avoiding emotional traps allows Buffett to stay calm while others panic, focused while others chase excitement, and patient while others rush. That emotional control is a major reason he consistently avoids bad investments. The final layer of avoiding bad investments is discipline in valuation and time horizon. Warren Buffett believes that even a great business can become a bad investment if purchased at the wrong price. Buffett never buys simply because a company is high quality. He buys only when the price offers a margin of safety. Without that buffer, even small disappointments can lead to permanent loss. Price matters, and ignoring it is one of the most expensive mistakes investors make. He avoids businesses that depend on perfect conditions to justify their valuation. If growth must remain high forever or margins must never decline for the investment to work, Buffett walks away. He prefers scenarios where things can go wrong and the investment still survives. Short-term thinking is another major cause of bad investments. Buffett does not invest with an exit plan based on market timing. He invests with the intention of holding for many years. If a business cannot be comfortably held through downturns, it is not suitable. He avoids leverage at the personal level as well. Borrowing money to invest magnifies mistakes and removes emotional control. Buffett believes that staying solvent and patient is more important than maximizing returns. Buffett also ignores constant market opinions. Analysts, commentators, and forecasts change daily. He focuses instead on long-term economics that change slowly. Noise creates urgency, and urgency leads to errors. Another critical discipline is knowing when to walk away. Buffett has passed on countless opportunities that looked attractive but did not meet his standards. Saying no is a powerful skill in investing. Every avoided mistake increases the odds of long-term success. He also accepts that not understanding something fully is enough reason to avoid it. There is no penalty for missing an opportunity, but there is a heavy penalty for making a bad one. Buffett structures his process to be repeatable and boring. Boring processes prevent emotional decisions. Excitement often signals speculation, not investment. By combining patience, valuation discipline, long-term thinking, and the willingness to do nothing, Buffett avoids most bad investments before they ever enter his portfolio. Avoiding losses, protecting capital, and letting time work quietly are the foundations of his success. Bad investments are avoided not by brilliance, but by consistency, restraint, and respect for risk. The final safeguard against bad investments is emotional control and self-awareness. Warren Buffett repeatedly emphasizes that temperament matters more than intelligence in investing. Most investors fail not because they lack information, but because they react emotionally. Fear during market declines and greed during market booms push people into decisions that permanently damage capital. Buffett trains himself to act rationally when others are emotional. He remains calm during crashes because he understands that market prices fluctuate far more than business value. When prices fall but the underlying business remains strong, he sees opportunity, not danger. When prices rise without improvement in fundamentals, he becomes cautious. Buffett avoids comparing his performance with others. Comparison creates pressure, and pressure leads to unnecessary risk-taking. He focuses only on whether his decisions are logical and aligned with long-term value. Another key principle is accepting mistakes early. When Buffett realizes an investment thesis is broken, he exits without ego. Holding onto a bad investment to avoid admitting error only compounds losses. He also limits the number of decisions he makes. Fewer decisions, made carefully, reduce the chance of large errors. Buffett waits for situations where the odds are clearly in his favor, instead of constantly being active. Simplicity plays a major role. Complex strategies often hide risks that only appear during stress. Simple, understandable investments allow clearer judgment when conditions change. Buffett builds systems that protect him from himself. Clear rules, checklists, and long-term thinking prevent impulsive actions. He knows that discipline beats brilliance over time. In the end, avoiding bad investments is about protecting capital, staying patient, and controlling emotions. Those who master these habits do not need extraordinary luck or constant action. By thinking independently, staying calm, and respecting risk, investors can avoid most mistakes and allow compounding to work steadily over the years.